Hello and welcome. This entire session has been put together by the incredible experts over at Pro Tax Accountant. Now, if you're feeling like your hard-earned money is constantly in a battle against taxes and inflation, you are in exactly the right place. Today, we're skipping the usual stuff, the standard stocks and savings accounts, and we're diving into some really powerful, tax-efficient strategies that you might not know about.
So let's just get straight to it. This is probably the very reason you're tuning in. Are your savings and investments finding it almost impossible to get ahead of inflation and taxes? It's a huge source of frustration for so many people in the UK right now, and it's exactly why we need to look for smarter alternatives.
And here is one of the main culprits, £3,000. That is your total capital gains tax allowance for the 2025/26 tax year. Now, to put that in perspective, just a few years back, that number was over £12,000. That massive drop means that even pretty small profits on your investments are now getting hit with tax, which really squeezes your returns. But look, it is not all bad news, not by a long shot. There are actually some fantastic government-backed schemes and clever investment structures out there designed to reward people who think a little bit outside the box. Thankfully, the specialists at Pro Tax Accountant have laid out a brilliant roadmap for us today. Okay, let's dive into this.
First up, we're talking about backing UK innovators. This is all about how you can invest in the future of the UK economy by supporting small, ambitious companies. And the best part? The government offers some seriously generous tax breaks to encourage you to do just that. Right, think of this slide as your cheat sheet for the three main venture capital schemes. You've got the Enterprise Investment Scheme, or EIS, venture capital trusts, known as VCTs, and the Seed Enterprise Investment Scheme, or SEIS. Now, just take a look at those income tax relief figures. 30%, 30%, and a whopping 50% for SEIS. These are designed to make investing in those higher risk, but potentially high-growth companies a whole lot more attractive.
So let's kick things off with the Enterprise Investment Scheme, the EIS. To put it simply, the government really wants to fuel the growth of the UK's next generation of companies. We're talking tech, research, all that innovative stuff. And to do that, they offer you, the investor, a pretty major tax break as a kind of thank you for providing the cash these businesses need to grow and create jobs.
So how does this actually work in real life? Okay, let's imagine Sarah, a freelance designer based in London. She's had a great year, but now she's looking at a pretty hefty income tax bill. She decides to invest £50,000 into a local tech startup that qualifies for EIS. Boom! Just like that, she gets to knock £15,000 right off her tax bill for the year. That's a 30% relief, straight away. It's powerful stuff.
And here's a pro tip for you, because this is where EIS gets really clever. We all know that investing in small companies can be risky. So what happens if the business you back fails? Now stay with me here. This next point might surprise you. This is where the idea of downside protection comes in.
Let's look at this example with Polly. She invested £200,000. Right off the bat, she got 60 grand back in income tax relief. Now, unfortunately, the company didn't make it. But here's the clever part. She could then claim loss relief on her remaining investment, getting another £63,000 back from HMRC. So her total tax relief was a massive $123,000. This means her actual money at risk on that huge $200,000 investment was only $77,000. It's a fantastic way the government helps to cushion the risk.
And believe it or not, there's even more. If your investment is a success, any profit you make is typically completely free from capital gains tax. Plus, after you've held the investment for just 2 years, it can fall outside of your estate for inheritance tax purposes, which is a brilliant planning tool. Oh, and with VCTs, there's another great perk. Any dividends you get are totally tax-free. Okay, so we've looked at backing innovators. Now, let's move on and look at how we can take something we all know, the ISA, and give it a bit of a supercharged twist. Most of us just think of ISAs for cash or stocks, right? Well, there's a much more adventurous option out there.
We all know this number, don't we? £20,000. It's our annual ISA allowance for the 2025/26 tax year. But the real question isn't just how much you can put away, it's what you can put it into. And that is where things get really interesting. Let me introduce you to the Innovative Finance ISA, or IFISA for short. The best way to think about it is it's the same tax-free box you already know and love, but it's designed to hold completely different things inside. Instead of shares in huge companies, you're holding loans and bonds, and you get to earn tax-free interest from them.
So what exactly are we talking about here?
Well, through an IFISA, you could be lending your money directly to small and medium businesses across the UK, helping them expand. Or maybe you'd prefer to invest in property bonds that fund new housing projects. You can even line up your money with your values and fund things like green energy projects. It's a way to get returns while directly supporting things you can see and touch.
Okay, now for the crucial part. The potential returns you can get from an IFISA are often much higher than you'd get from a cash ISA, but, and this is a big but, that comes with higher risk. It is so important to remember this is an investment, not a savings account. The businesses you lend to could fail to pay you back, which means your capital is at risk. And unlike a bank account, these investments are not protected by the Financial Services Compensation Scheme, the FSCS.
All right, we've gone from government-backed schemes to peer-to-peer lending. Let's now head to the digital frontier and talk about a topic that confuses so many people, cryptocurrency. It's a massive topic, but our focus today is very, very specific. We're not debating whether you should invest. We are simply going to try and untangle the complicated UK tax rules that go with it.
And just to be absolutely crystal clear on this is not investment advice. Whether you decide to get involved in crypto is a totally personal choice. Our only goal here today is to explain how HMRC, the UK's tax office, looks at these assets if you do decide to buy, sell, or trade them.
This slide right here breaks down the single biggest point of confusion. You've got two main taxes to worry about: capital gains tax and income tax. Think of it like this. You pay capital gains tax on your profits when you dispose of your crypto. That means selling it for cash, trading it for another crypto, or even using it to buy a coffee. On the other hand, you pay income tax when you earn crypto, like if you get paid for a job in Bitcoin or from activities like mining.
So let's have a quick look at the capital gains tax rates for crypto for the 2025/26 tax year. As you can see, if you're a basic rate taxpayer, you'll pay 18% on your profits. If you're a higher or additional rate taxpayer, that jumps to 24%. It's just important to know that these rates can be different from the capital gains rates on other types of assets.
Okay, let's walk through some simple maths. Let's say you sold some crypto and made a profit of £10,000. First, you get to deduct your annual capital gains allowance, which is £3,000. That leaves you with a taxable gain of £7,000. Now, if you're a higher rate taxpayer, you'll owe 24% tax on that amount, which works out to £1,680. See, when you break it down step by step, it's a lot less scary.
And here is another huge pro tip, and honestly, so many people miss this one. Don't just track your wins. If you sell crypto at a loss, you can and you absolutely should report that loss to HMRC. Why? Because you can then use those registered losses to cancel out any capital gains you make in the future, which can seriously reduce your overall tax bill. Keeping good records is everything here.
Whew, we have covered a ton of ground, from backing brand new UK companies all the way to the world of digital assets. So let's take a breath and bring all of this together and think about your next steps.
So, what are the big takeaways from today? Number one, venture capital schemes like EIS and VCT offer really high tax reliefs to reward you for taking on higher risks with UK companies. Number two, the innovative Finance ISA, or IFISA, gives you a way to get tax-free returns from lending, totally outside of the traditional stock market. And number three, crypto is its own beast, with its own very specific and complex tax rules that you just have to get right. Now, this is really important, so please listen closely. Everything we've talked about today has been for general information only. These are complex investments, and the right choice for one person could be the wrong choice for another. Your personal situation is completely unique, so this should never be the only thing you rely on to make financial decisions.
So the final question is this. After all that, you're probably feeling a bit more empowered with all this new knowledge. But do you have a clear plan? Because that's what really makes the difference.
Before you make any decisions, the smartest move is always to consult an expert. For professional advice that is tailored specifically to you and your financial goals, you should get in touch with the specialists who put this whole session together, Pro Tax Accountant. Their details are on the screen for you right now. You can call or WhatsApp them on 07985 689 912, or you can drop them an email at info@protaxaccountant.co.uk. Thanks so much for joining us.